Okay. I want you guys to use the old way of doing things. Why? Because that one is not going to be tested. And when you do that one, you're not going to get your answer. And you'll be disappointed with the Acca tutor. And I don't want that. So somebody's asking, what is a CPI? What is a CPI index? A CPI index is a consumer price index. All right. So you are going to be given consumer price indices. All right. These would they would come up with the same effect as that inflation allowance. Okay, we just have to modernize things, isn't it? Things have been modernized. All right. So CPI index, you'll be given 3 or 4, sometimes 2, okay, depending on whether the examiner wants to be pedantic or just to be simple, a simplistic person. Okay, so let us give this question. Let us say when the shares were bought in 2020, the 2010 here, the May 2010 should be, let us assume it's May 2020. So let us say the 2020 CPI was 100. The 2021 CPI was 150, and when the shares were sold, the 2024 CPI was 220. Okay, you'll be given. This is what normally happens, isn't it? So what you need to do is to then, when you compute your cost, the cost of the asset sold was 2,500. So the inflation adjusted cost will be multiplied by, you need to multiply by, the difference of the CPI at disposal, which was 220, because this is the 2024 CPI where the asset was sold, isn't it? Minus the CPI when the asset was bought. Okay, minus the 100, which was the base year, over the base year or the year, the CPI during the year of purchase. Okay, that's the base year index. All right, now this should give us an index, the cost of how much. This should be 220 minus 100, that's 120, isn't it? Over 100 multiplied by 2,500. This means that the cost for this asset or for these shares was $3,000. Okay, we are only computing the cost for now, all right, because we need that figure in our computation. So now, after getting the costs, we then have to come back and compute the whole CGT using the CGT tablet, isn't it? Let me try to tidy up the space. Sorry to eat much of your time. Okay, so now we know to compute CGT, we need the proceeds. The proceeds, how much was given? We're given $7,000 as the proceeds. And this person is an elderly person. Elderly. credit, the elderly credit. During this period, because the examiner will give you much of the information, so you just have to go back to your text tables. Okay, in this particular year, how much was given for elderly people? So here, the examiner specifically stated that income from the sale of disposal of marketable securities, this amount 1,800 was given. Okay, so the examiner is likely to give you the information for the text tables. Do not worry, do not click your head and start to cram all of these things you won't be able to manage. So, hopefully you'll be told in the current text tables, such type of an item, I tried to look for it. I could not locate one. Okay, if you look, this is the current text table. For elderly persons, 55 years and above. We don't have such type of thing. All right. When they sell marketable securities, we don't have any such information. But if the examiner is interested, she's going to tell you. All right. So you may assume that it is now 3,000, but the examiner, if it happens that a similar question comes, please look at the tables. The text tables are there to assist you, will assist you. So let us use the 1.8, which was provided for by the examiner during those days. So like I said, in the exam, when a similar question comes, go to the text tables under the elderly persons and you see whatever exempt income they would here for rentals. If they own an apartment and they are renting it out, remember that they are elderly people, so they are entitled to a 3,000 tax credit on that income. So you first have to deduct 3,000 before you commit any CGT. You commit any income tax available or applicable. And when they earn interest on deposit with a financial institution, also remember that they are entitled to 3,000 and then interest on discounted instruments, they are also entitled to 3,000. And if they make a gain on the sale of a PPR, a principal private residence, it means that that gain is exempt from income tax. Do not charge tax. You just have to pick a zero, right? And benefit derives from the acquisition of a passenger motor vehicle from an employer is also exempt. Do not charge, a gain on the deemed benefit. Why? Because they are exempt from such taxes because of their age. Is that clear? Good. So I'm sure we can proceed safely. We are on the same page. So let us use the 1.8 there to complete this particular question. So the elderly credit by then was 1,800. Then the cost, we deduct the cost according to our CPI computations. The cost, this is the cost we calculated, ladies and gentlemen, and it was 3,000. So the taxable gain, this is the gain. How much is the gain now? The capital gain, that's 7,000 minus 1,800 minus 3,000. So that's 2,000. Hey, what's happening with my pen? 2,000. How much? 2,000. 2,200. Okay. And then we apply the CGT tax. So CGT at what percentage? I'm sure it should be 20, isn't it? Let us go to the tax tables. So we have come to tax tables. These are the 2025 tax tables, which are applicable for the tax period 2024, right? So they are very, very current and applicable for our examination. So you need to read around, because if you simply just rush, you will pick an inappropriate rate and you'll be penalized for that. So this guy, this person in question, the individual in question, Lynn, okay, remember this is our question. She bought, like I said, she sold the unlisted shares on 9 April 2024, right? Yes, that was 9 April 2024. All right. Now, she had bought these items on 10 May. Okay, the date was 10 May 2020. Okay, like change the 2010 to 2020 so that the questions become as palatable, as relevant as possible. So when we get to our, if we come to our text tables, you'll be having a lot of literature here, and you just have to be very, very tactical. We are told here that if the immovable property and unlisted marketable securities are acquired or were acquired after 22 February 2019, you need to use a flat rate of 20% on the gain. So which means you just have to apply 20% on the gain and you get the CGT. So in this case, the securities were acquired in 2020. That was way after the 2019 era or February 2019. So in that case, we are allowed to use the 20% on the CGT. Am I talking to somebody? Are we together, guys? Good. If these items were acquired before 2019, what we were going to only do was to apply a 5% on the gross amount of the proceeds. In that case, you won't worry about the CPI computations, inflation allowance, or whatever. You won't be allowed to do those things. All right? Good. So in this particular case, the shares were acquired after 2019 and the applicable tax rate there is 20%. What about if they were, listed securities on the ZSE and so forth? What do you do in those situations? Disposal of listed marketable securities. If they are held by the seller for less than 6 months, you apply 4% on the gross proceeds. If held by seller for 6 months or more, you apply 1.5% on the gross proceeds. This is clear and straightforward, isn't it? Good. So let us come here. You guys, when you pass, please just give me a thumbs up. Just tell me, hey, Acca tutor, you were too much. You were so much. You were wonderful. You were good. And guys, please don't forget to subscribe, to like, to share this video. All right? Make your comments on the comment section to the video so that the videos go viral, so that I become known. I need to be in business, guys, okay? So this one was just a giveaway to you so that you understand where we come from and where we are going. Please, I want you to pass. But tell your people, to your friends, to your peers to come to school. After you guys pass, please come to school so that we start together. All right, much of the nonsense. Let's proceed. So, getting back to our question, we then have to apply the 20% on the gain. So we are now safe and comfortable that the applicable rate here is 20%. Don't just say CGT is 20%. No, it doesn't work like that. You will fail. Know where you get the 20% from. Okay, good. Now, 20% of 2,200, I think it's something like 440, isn't it? Is it so? Or we need to verify? Okay, where's the calculator? 2,200 multiplied by 20%. Yes, 440. So that one was the answer. And somebody started to say, oh, I mean, but we didn't have 440 on the, choices given. Yes, like I said here, what was used was the computation where we used the 2.5%, okay, 2.5% to adjust for the inflation. Oh my God, the inflation allowance and so forth. That one, that's not what we do, okay? So for this question, what I want you to verify in the exam is you need to verify the tax credit, under the CGT. Bro, remember, these are not the mainstream, these are not ordinary income tax credits. These are tax credits applicable in the CGT computation, the capital gains tax computation. So do not mix the two. They are different. All right, they are different. So if you are that late in this particular exam, you will pass. I can bet with my salary, you will pass. If you are late in this particular exam, you will pass. Okay, like I said, these, okay, you just have to pick where relevant things related to capital gains. All right. So if you get the similar question and the examiner is not explicit, you can use this. These amounts. Okay, if the examiner brings the same question, and always assume that a tax credit for the elder should be there. Do not just ramble and compute ordinary CGT computations for younger people. You'll be in for it. Okay, it's just a warning, guys. Do not be paranoid. Okay, let's move. There is another joint breaker. Job breaker here. This is a job breaker. Question 9. Titi is an employee and contributes $300 monthly to a retirement annuity fund. And I know some of you guys are saying, oh man, Acca tutor, that was the troublesome question ever. Yes, it is indeed, but you have come to the solution, isn't it, guys? So you need to congratulate yourself. If you have reached this far into this video, please congratulate yourself. You have actually arrived at the rich ground. So, since he's an employee and contributes $300 monthly to a retirement annuity fund, RAF, she also pays the maximum amount towards the National Social Security Authority, the NASA, monthly contributions. And somebody's lost already, is lost. And it's, oh man, oh my God, this paper, how I had it. Do not hate this paper. This is a wonderful one. What is the total amount of Titi's allowable deductions from employment income in respect of her retirement and its fund and National Social Security Authority contributions for the year ended 31 December 2024? And some of you guys have a tendency of just being lazy. And when you are lazy, you simply just say, oh man, from the text table, we were told by our tutor that, oh man, the maximum threshold is 5,400. So just pick 5,400 and go on with your life, baby. No, baby, you're gonna fail. This is a very serious examination. You're gonna fail. I bet with my salary. So do not just ramble, do not just guess these things. There is a way of getting the marks correctly. So let us do it step by step. So the first thing we need to do is to deal with the RAF, those contributions. So let's start with the rough. The rough. So per month she's paying $300. 300. By how much? By how much? By 12 months. And this comes to 3,600. Okay, so when we get to the tables, always refer to the tables. So when we get to the tables, the text means, rules and regulations. We come here. These are allowable deductions. Anything outside this is not going to be allowable. So, the RAF, are they here? Where are they? In relation to each contributor to a retirement annuity fund, the maximum allowable deduction should be 2,700. Okay? And my list, guys, simply read this portion. Aggregate maximum deductible contribution to all the above per employee or contributor per year, 5,400. This is only applicable when you have satisfied yourself that everything here is now, when you have taken care of everything, then this figure has been exceeded. Then that's when you just simply pick up the figure. But now, here, when we look at the question is saying she was contributing $300 per month to the RAF, and part of her contributions were channeled toward the NSSA. So 300 multiplied by 12, that's only 3,600. Okay, be serious. So we have taken care of the 3,600, and we said this is now too much. We're not allowed to do this. We are only going to stick ourselves on 2,700 for the RAF. So when we come back to our solution, if we come to the solution, we're going to say the applicable amount, the applicable amount is not 3,600, but 2,700. Is that clear for the RAF? What about for the NASA? This is now the elephant in the room. This tends to be, dangerous. NASA is dangerous. Even I myself, during those days, I would run away. When I see the NASA computations, I would run away and say, oh man, God, spare me the trouble. Anyway, let's proceed. So, if we come to the tables again, so we are told she's paying something to the NASA. She's paying the maximum. If she's paying the maximum, what is the maximum? The maximum payable to NASA, ladies and gentlemen. NASA Social Security contributions on a monthly insurable earnings of 700. So the maximum insurable earning is $700. No matter you are getting 2,000 per month or you're getting 10,000 per month, but the maximum the NASA can assure, oh my God, or can insure, they can only cover for income up to $700. Any extra is not going to be covered. All right, this is a way of the state trying to prevent over insurance. Okay, because it's a cost to the state, isn't it? It's a cost to the NASA. So if they over insure people, they might end up failing to cover whatever claims they will be having. Because by the end of the day, these people, when they become pensioners, when they leave employment, they need a caution. So it should be a reasonable caution, not that over optimistic or a non of this world type of package, right? Something too Hollywood, something too superfluous, something that is from the the Wonderland type of thing. No, right? We are not going to live in Wonderland after employment. We are going to live in a real world that knows costs, that knows pains and burdens. So the type of caution we are going to give you is just a reasonable caution. That's where you're going to land on, my friend, you and I. Okay, so the maximum income they can insure is 700 USD. All right, so let us compute this amount. The amount of contributions which could be deductible for tax purposes. That's $700. Sorry, this. Oh man. Let us get to the question paper. We are talking of $700. 700 multiplied by 12. Multiplied by 4.5%. Remember, there is a percentage of 4.5% on the insurable earnings. And the insurable earnings, this lady has reached the maximum. Maybe she was earning 1,000 or 2,000 per month. So she has reached the maximum that could be insured. So in this case, she has reached the 700 limit, and we then multiply that by 12 months in a year, multiplied by the percentage insurable. Okay, so that's 4.5% on an income of $700. So we get back to our other sheet. Multiplied by 4.5%. And what do we get? This is very, very small figure. And if you simply pick your 5,400, you will be thrown overboard. So that's 700 multiplied by 12 multiplied by 0.045. That's 378. So if you add this, you're going to find that we are on 3,078. Yes, this amount is not going to be found there. Why? Because remember, when they did their computation, they were not using the 4.5%. Okay, here they used, let me show you what they used. They used 3.5%. All the figures, I think they're just the same. They're just the same. Even the this 2.7 was just the same by then. Let me show you how they differ. They used a 3.5%. Let me take you to their page. You see, they were using sorry, where's the pen? 3.5% of gross, but everything is just the same, isn't it? But they were using 3.5%, so this is why the figures tend to differ. But everything is just the same here. That's what was here as well. Just the same, except that here we are using 4.5%. So, that's it, ladies and gentlemen. So if you want to see if we get the answer there, let us use 3.5 instead of the 4.5 and see what we get. We are saying 700 multiplied by 12 multiplied by 0.035. That's 294. Okay, so if you say let I just say here 2,700 plus 294, you come to 2994, and you discover that your answer would be B. However, if you update this, you discover that you must get this one, the 3,000, the 3,078 as your answer. So that's how, ladies and gentlemen, you are supposed to attack a question of this nature. It is going to come in your exam, I bet. The NASAs, the RIF, they are always resident in this examination, and you just have to be very comfortable. Oh my God, you need to be very, very comfortable with them. Okay, let's move on to question number 10. So, J Limited issued a tax invoice for goods sold of $20,000, including value-added tax in December 2024 to its customer. Later in the month, the customer returned goods valued at $6,000, including VAT, as they were below the expected standard. So in this case, you would see that the VAT output has been reduced. Why? Because we now have sales returns. In this case, when you compute the output tax, you need to deduct the goods sold. All right? And remember, the figures should be like and like. Here, they sold goods including VAT, and here we are given the sales returns were also including VAT. All right, so before you do your deductions, make sure they are of the same base. In this case, they are of the same base because all the figures are including VAT. All right, so if one of them was not including and the other was including, then you need to first of all match to ensure you have figures which are inclusive of VAT before you do any addition or subtraction. Is that clear? Good. During the month of December 2024, JJ Limited owned only one passenger vehicle which had an engine capacity of 2,800 cc used. The use of which was, the use of the vehicle was provided to the production manager as a benefit of his employment. So the vehicle was given to the production manager, as an employment benefit. And being a benefit, obviously, we need to charge the employer. For doing that, we charge VAT. So there is also output VAT output to be charged. So how many outputs do we have? We have the output tax on the sale of goods less the sales returns and the VAT output. But the VAT output is based on the deemed cost of the benefit, and we are going to get this from the table of benefits. As a 2,800cc vehicle is accruing how much benefits will come here. The deemed benefit. So 2,800 is in this particular bracket. Okay, that's where we get our benefit, and this benefit is 1,250. So with this knowledge, we can safely prepare our computations. So first of all, let's compute the output, the ordinary output tax from sales. That's we have got a 20,000 inclusive of VAT minus the sales return inclusive of VAT, and we get 14,000 as the output is the cells leading to the output text, isn't it? Or what is it? What is it? Okay, all right. Because it's not the output text so far. It's still the cells which are textable. But for us to get the output the text or the VAT component in these were inclusive. Okay, they were inclusive of VAT. So to get the output from the figure that is inclusive, we need to say multiply by 15 over 115, isn't it? So this one, that's multiplied by 15 over 115. That's now the output text we are talking about, and it should give us something. Don't be scared of coming up with the wrong answer. This is practice, isn't it? Just doing the practice mode. 15 over 115. So here we are having 1,826. Did I do my, yes, 1,826. Okay, but now we do not stop there. There's also the deemed benefit, the PMV benefits, the passenger motor vehicle, PMV benefits, and this one was, we said it was 1,200. The deemed benefit, remember, the deemed benefit here, that's 1,250. Okay, 1,250 multiplied by 15 over 115. This should be 250 multiplied by 15 over 115. That's 163. So we need to add plus 163. And what do we get in total? The total VAT net amount in respect of, what is the net amount of VAT? Okay, so the net amount should then be 1826 plus 163. That's 1989. And somebody started to ask me, but we don't have that amount here. We don't have that amount. What are you doing? What are you saying? Okay, the difference has generated from the aspect of the PMV. I've used the deemed benefit here. The 1,250 is from the current table. Previously or back then, the amount of benefit was, remember, it's within the range there. They were using 7,200, but it's now 1,250. You can see. So if we use the 7,200 there in the equation, the 7,200, if we had used 7,200, we were going to say 7,200 multiplied by 15 over 115. This should be how much? 7,200 multiplied by 15 over 115. 939. It was going to be 939. And we add it to our original computation there, which was 1,826. So the amount we were going to get was supposed to be, let us just say plus 1826. It was going to be 2765. 2765. 5. Oh no, I made an error. Okay, this is an error which I don't want you guys to make. It's a terrible error. Okay, it's a very, very terrible error. And here we're lucky, or we would be lucky if the examiner didn't want to put that one as a pitfall. All right. One thing I failed, or I missed was that this vehicle was not in business for the full 12 months. For the full 12 months. So what happens is you need to prorate the benefit. Benefits are normally prorated, isn't it? So it was only for 1 month. So the PMV benefit should further, even on this, we should have multiplied the 163 by 1 over 12. Okay? And here again, the amount, this should also be prorated by 1 over 12. So let us do that one and see. So we are saying 7,200. Am I doing the correct here? 7,200 multiplied by 15 over 115 multiplied by 1 over 12. It comes to 78. So 78 plus, so here it should be, oh my God, it's getting messy. Oh, so it's getting messy. So we are saying 78 plus 1826, 1904, and 1904 is there as D. But like I said, we need to then upgrade because it's no longer the 7,200 which was applicable in those days. It is now 1,200, which is the benefits from the current tables. All right, and if you adjust accordingly, the 163 multiplied by 1 over 12, 163 multiplied by 1 over 12 should give us 14. Okay, 3.5, that's 14, isn't it? So this would significantly reduce our amount. So we now have 14 there. Plus 14, this comes to 10, 3, 4, so it comes to 1,840. That's the new correct figure, and that is not found here. Why? Because those figures were meant for the 2014 tax year, not the 2024 tax year we are going to be tested upon. So we are trying to bring the questions to their relevant tax period, which to some extent could be impossible because some of the items, some of the things would have been abolished by the tax laws. But we are trying to give you more information and update so that in your examination, you're not going to be found wanting or to behave, to show these, these symptoms of self-study, because self-study is so painful, and sometimes you might tell yourself that you know when you do not know. So you need a tutor. In your upcoming examinations, please consider engaging the Acca tutor. I'm there for you. I am going to assist you. I am teaching a lot of students out there who are benefiting, and why not also join the bandwagon, the golden fleece, so that you drink from the same pool of knowledge. Let's proceed. Okay, number 11. Let's do question 11, ladies and gentlemen. Remember, it's very, very, very simple. You need to practice right now. You need to practice so that when you enter into the exam hall, you're not going to, to start to confuse yourself and say, what was the Acca tutor doing? What was he saying when he was doing A, B, C, D? You need to practice a lot of questions using all the updates I've given you so that your journey is going to be smooth. Teddy resigned from his government post during the year ended 31 December 2014. Remember, 2014, that's 2024, isn't it? All right, so he resigned on 31 December. The examiner is saying during the year that ended 31 December 2014, that's when he resigned. At the same time, he withdrew 40,000 USD from his government pension fund as a refund of his pension contributions made in earlier years. A total of 8,000 USD of his original contribution to the pension fund were disallowed for tax deduction when made. So when he made the contributions, 80,000 was not allowed. All right. Why wasn't it allowed? It was considered a capital contribution. All right. So or a capital expense. So when he was making the contribution, the taxman did not allow him to deduct those. All right, so in a way, the taxman taxed him on those contributions. So shall he tax him again when he make the withdrawal or when he gets the refund of those contributions? No way. The taxman has already taxed him prior. So when you then compute, because the question is saying, what is the tax payable on Teddy's refund of pension fund contribution in the year ended 31st December 2024? So during the computation of the tax payable, you need to deduct the 8,000 from the amount received. He received how much? The receipt was 40,000. And then the capital amount of the contribution should be deducted, which is the 8,000 should be removed. You must not tax him twice, because when he made the contributions, maybe they were those items which were above, the deductible amounts. So because he was taxed when he was contributing, he cannot be taxed again when he is receiving the refunds. It won't be a fair world, isn't it? Remember, taxes are not meant to punish subjects, but to empower them, isn't it? Good. So, in this case, you need to remove the 8,000 and you remain with the taxable amount of 32,000. So how much tax? Because they want the actual figure there. So for us to know whether we are going to use 25%, 20%, what, we go to the payee tables. Those are the tables for employment income. Remember, he resigned from a government post. He was an employee. So we go to the employment tables, the payee tables. But when we go to the payee tables, we need information of his annual income. The annual income. So the taxable income from employment included, amounted to 125,000 for the year ended 31st December 2024. So that is giving us more power now. We can safely then go to the tax tables. But then, when when the question was given, the tax tables were showing this amount. But when you attempt your questions, please use the current tax tables which will be provided to you in the examination by the examiner himself, and do not cram these things. Okay, so 125 was within this particular bracket, the 120,001 to 240,000. So the applicable tax rate there was 45%. Do not worry about, those moderations where we say we start up to 40, up to 120,000 and then this and that. No, that is not required at the moment. You simply have to go straight to the tax bracket, you pick the percentage applicable there, and you move on with your life. But don't forget the 3% AIDS levy. Remember, the 3% AIDS levy is 3% of 45% in this case. It's 3% or 45%. A lot of students make mistake and say it's 45% plus 3%. Then they use 48% and they find it that they have failed and they start to worry. Yes, you'll be worried, but you would need to rewrite the paper again. So don't make that mistake. It's 45% multiplied by 3%. Okay, this this gives us the amount of the aid levy payable. Okay, but what we need when you want to combine this, it should be 45% multiplied by 1.03, and this will give you the percentage, the shortcut you need, isn't it? You need that shortcut, and the shortcut should be, if we say 45 multiplied by 1.03, we get 46.35. This now includes the AIDS levy. Okay, some people are saying, so why did you write that one first? Okay, let me just complete here. So when we say 45 multiplied by 3%, what do we get? Let us see. 45 multiplied by 3%. We get 1.35. That's 1.35%. And that is now the percentage which should be added to the 45%. So if you add 1.35 to 45, you are going to get 46.35%, which is the same as this amount. That percentage. Okay, please get this right. It's either you go the longer route or the shorter route. But for the shorter route, you need to be very, very aware of those, connotation, those tricks and so forth, because you might throw yourself out of the race just because of the shortcut. So be careful, know where it emanates from. Okay, now, so we pick the 45% and we move on with our life. 45% is the applicable rate. So tax at that's, we said 45% plus 1.35, so it comes to 46.35, because now this one includes the AIDS levy. So let's do the computations. That's 32,000 multiplied by 46.35. Oh my God. Oh my God. Okay, let me just say divided by 100 because I did not put a comma there. Comes to 14,832. 14,832. That's the answer. Let me just redo the computations because somebody would be lost. I'm saying 32,000 multiplied by 46.35%, that's 4.04635. Yes, 14,832. Is that clear, ladies and gentlemen? This is not a straightforward paper. You need to, understand what will be going on, what will be happening, and so forth. Let's move on. IB Limited is currently preparing its self-assessment return for the year ended 31st December 2014 and its pay as you earn return for the month of December 2014. So they are preparing a self-assessment return and a payee return. Okay. By when should AB Limited submit both its returns to ZIMRA, the Zimbabwe Revenue Authority? By when? So you might not be knowing the due date for self-assessment return, but you should be knowing the due date for payee, isn't it? For payee. All right, remember, payee for a month. The month here in question was December. So payee for December should be in the hands of ZIMRA by when? So payee, guys, is due by the 10th of the month following the applicable month, or following the month to which it was deducted, or from which it was deducted. If it is for December, if it was payee for December, or that's the month when the employment income was earned, isn't it? So that's the month when the employment income, or when the employment tax, the payee was deducted in December. So it should be remitted by the 10th of January. Okay, so we have got this, which has got the 10th of January, and this one again, 10th of January. Then we just have to understand here, self-assessment returns, these ones are, or should be given, you just have to claim this, they should be submitted by the 30th of April following the year, or following the tax year to which they relate. In this case, they relate to the 2024 tax year, so they should be remitted by the 30th of April 2025. Is that clear? Good. So our answer is A. Question 18. Liz earned the following gross income from investments during the year ended 31st December 2014. Interest on savings account with the commercial bank, 2,500. Interest on a savings account with the POSB savings bank. Post office savings bank. All right, so this one is exempt. Interest on this is exempt. Dividends from a company listed on the stock exchange. So what is the amount of withholding tax deductible from lease, interest, and dividend income for the year ended 31st December 2024? Okay, so the applicable rates are given in the text tables, ladies and gentlemen. Let's start with the interest on savings account. How much is to be withheld? So we go to the withholding tax tables. Everything is given by our, lovely examiner. No, that's withholding taxes. So on dividends distributed by Zimbabwean resident company to resident shareholders other than companies and non-resident shareholders by a company listed on stock exchange, that's 10. If this was a company listed on stock exchange, the withholding tax was going to be 10%. But let us hear from the question whether it was a listed interest on savings account, dividends received from a company listed. So here, this one, here, we charge 10% withholding tax as given in the table. Remember, the table says if it is from a listed company, if there are dividends by a company listed on the stock exchange, the applicable withholding tax rate is 10%. Okay. What about the interest now? Resident tax on interest from building societies or from other financial institutions, we are going to use 15%, 15%, isn't it? So there we come to the question and apply here. Now for interest, we are going to apply 15%. So here we said we put a 0 because it's an exempt. We don't withhold anything, but for the 2.5, so the government is simply saying, hey man, you need to invest with the POSB, okay, the Post Office Savings Bank. Wow. Anyway, that's 2,500 multiplied by 15%. Oh my God, tax has been made simple this December 2025. Tax has been made simple. Here, that's 1,200 multiplied by 10%. This should be 120. So if we add our figures, that's 5, that's 9, that's 4. So our answer should be 495. No need to guess, guys. No need to guess. This is a simple exercise. Very simple, isn't it? Good. Number 14. Flight Transport Limited submitted its self-assessment return for the year ended 31st December 2023 on November 2024. What is the penalty which will be levied on Flight Transport Limited in respect of the late submission of its tax return? So if if you delay, oh my God. So how many days are we looking at here? Remember the due date should be 3rd April, right? 3rd April. That's 3rd April 2024. That's when this company was supposed to have lodged their self-assessment return. But they lodged it almost 6 months late on the 2nd of November 2024. So how many days were they late? We have got May, we have got June, July, August, September, October. So May has got 31 days, June 30 days, July 31, August 31, September 30, October 31. If we add up all these days, they come to 184 days. Now, according to Zimbabwean tax law, a defaulter has to pay $30 per day. Okay, you pay $34, $30 per day multiplied by 100% of the amount. Okay, but we don't penalize forever. Okay, the self-assessment has got some due dates. The penalty has got a maximum limit, so it's up to 181 days. 181 days allowed. So that's 181 multiplied by 30 multiplied by 100%. $30 is penalty, is a daily penalty, right? So here they have taken 184 days, but we are only allowed we are only going to charge up to 181 days. So that's 181 multiplied by 30 multiplied by 100%. That's 181 multiplied by 30 multiplied by 100%. 100% is just 1, isn't it? So that's 5,430. So this one was a relevant question, and it's still relevant even now. The $30 is still being applied per day. So it will be, too much, isn't it? But paying this penalty is not going to excuse you. The question only requires the penalty amount. But if you were owing 300,000 of taxes, you need to pay them on top of the penalty. Get that right. Sometimes the examiner would also be interested in the tax payable plus the penalty, and you need to pay all of them. So the penalty doesn't mean, the payment of the penalty doesn't mean that you have paid the taxes outstanding. You still have to pay for those taxes. The last question. Remember, this part, the section A, is worth 30 marks. So it's very easy to get your 30 marks, isn't it? Acca Limited received a net management fees. Acca Limited received net management fees of 35,000 USD from its Botswana-based subsidiary company during the year ended 31st December 2024. The amount received was net of foreign withholding tax deducted of 15%. So in Botswana, they have already deducted 15% on the management fees. But if there is a double deduction tax agreement, then there should be some relief of some sort. If in Zimbabwe the tax rate is higher, okay, if the tax rate is higher, then they would have some relief on the amount they would have paid, and they would then pay the difference, isn't it? How much double taxation relief can Acca Limited claim in respect of the management fees received? Like I said, the relief is the lesser of the two tax limits or tax rates. The lesser of the two, right, should be the relief. So in this case, if the Botswana rate is lower, then it means that the relief should be that the amount payable using that lower rate. So let us do the computation so that you guys see what I'm talking about. So we are saying this was the net amount they received from Botswana after the taxation was deducted. So we wanted the amount of tax which they paid. So how do we know the amount of tax they paid? The amount of tax is only found from grossing up the amount, because this was a net amount. So the grossed figure, the grossed receipt, that's 35,000 multiplied by 100 over 85. Why 85? Because they have deducted 15%. So we want to see how much was or were the fees before taxation. So this should lead us to 35,000 multiplied by 100 over 85. So the fees were 41,176. Those were the fees, isn't it? Good. Remember, we are in dollars. Sorry. All right. So the amount of text in this figure is the very important one. So text deducted there was 41,176 multiplied by the tax rate in Botswana, which was 15%. So which means the amount of tax already paid should be this figure multiplied 1176 multiplied by 15%. What's happening? Oh my gosh. 41176 multiplied by 15%. So that's 6176. All right. Now, in Zimbabwe, let us look at the situation in Zimbabwe now. In Zim, the tax would be what? Tax is equal to 41,176, which was the amount. We are using the gross amount of the receipt multiplied by the tax rate for companies. Companies are paying at 25% plus 3% AIDS levy. 25% plus 3% AIDS levy, remember, refer to how we compute these things, should be 25.75%, not 28%. It's 25.75%. Remember, it's 3% of 25%, not 3% plus 25%, but 3% of 25%. Okay? That's the age levy. Oh my God. This is tax, man. Oh man, let me just illustrate it. Oh man, I want you guys not to be confused. How I obtained the 25% from the tax rate. This is a company. These are companies we are talking about, and companies are corporates, and corporates have got a special rate for them. There's a special rate for business income, isn't it? Companies. Where is that thing? For companies. Yes. No. What's going on? Okay, here. Okay. Tax rates other than employment income. All right. The basic rate is 25%. Then you need to add 3% age levy. All right. So the question is, how do we then come to 25.75? We are saying this is 25% plus 3% age levy, which should be multiplied. Okay, this should be multiplied by 1.03. Okay, and you should come to 25.75%. Let me do it. 25 multiplied by 1.03. I don't know what's going on with my keyboard here. That's 25.03. Or we can do it step by step and say 25 multiplied by 3%. Because we are saying it's 3% of 25% multiplied by 3%. We get 75%. And then we add the 75% to 25. Is that clear? Good. Some are saying, oh, but you put decimals and so forth when this 25% is a percentage and so forth. Okay, let us try to do what they want. We are saying this is 25. Okay, that's 25. And we are saying 25% multiplied by 1.03. We still come to 25.75%. That's 0.25. I mean, 0.2575, that's 25%, 25.75%. Okay? So it's just the same thing, isn't it? Okay. Great. Anyway, I'll be doing that so that we understand where we are coming from. So that's why we are using the 25.75% in our computation. So let's move on. We have got this figure, and let us then put it in our calculator. 41176 multiplied by 0.2575. It comes to 10,063. 10,603. Okay. So the relief, like I said, relief there is the lesser of the two. The lesser of the two. The lesser of the tax deducted in Botswana and the tax to be deducted in Zimbabwe. So if they come to Zimbabwe now, all right, because Zimbabwean tax is higher, all right, they would have a relief of the tax they would have already paid, which was this amount. So that's the amount they are entitled to. So the answer there becomes B. We've done almost everything, and somebody still say, oh man, you didn't do capital allowances, so I'm not going to write to the examination. All right, that's a bonus. Let us try to find if we have a question on capital allowances. Okay, that question paper was the 2015 question paper, December. So this one is a 2020 December question paper, which I think, let's do this question. It has got some capital allowances and it's a little bit interesting. It's not as boring as the questions we've been dealing with so far. It was so boring. Okay, are you guys seeing my screen properly? Yes, I know it's not clearly visible, but let us copy it. Let's copy it. Loretta acquired and brought into business use the following property and equipment during the year ended 31st December 2019. Like I said, just tell us off, it's 2024. We have got farm, 150,000, passenger motor vehicle cost, 95, commercial vehicle, 135, tractor, 100,000, fiscal advices, 50, irrigation, not immigration, but irrigation equipment, 170,000, and the total came to 700,000. What is the maximum amount of capital allowances which Loretta can claim in respect of her fixed assets acquisition for the year ended 31st December 2025? So, first of all, you need to tell yourself these assets, do they qualify for capital allowance in the first place? We know land does not qualify, and if it doesn't qualify, excuse me, then it has got a zero, isn't it? So, because if they are claiming maximum capital allowance, the maximum they can be is special initial allowance of or SIA. Okay, and the rate of SIA from our tax table is 25%, isn't it? Okay, good. So here we've got a zero, zero. What zero here? This is what we can say deemed cost. The deemed cost of the asset. Yeah, the examiner could give us a figure, but there could be some deemed costs in the eyes of the taxman. For example, the cost of the farm in the eyes of the taxman is zero. Why? Because they do not consider them for capital allowances. So in the capital allowance sense, the cost is zero. What about commercial vehicle? Passenger motor vehicle. A passenger motor vehicle usually attracts what are called deemed costs. And I want you guys to verify. I think it's 80,000. Okay, but verify with me. I want your comments in the comment section so that you assist other students as well. Yeah, I'm feeling let us use 80,000 for now. But I'm failing to get an update. It used to be 80,000 all along, but there could be some changes on that. And if you are updated, I think it's 80 or 100,000, but you can use both. Okay, in the exam, you can use both, and you find out which one has got a solution there. But if both are then appearing, both figures are leading to two solutions at the same time, then you'll be in for it there. I'm sorry, guys, there. I'm not quite sure. I tried to visit the Wizimra website, and I'm not finding anything to assume the cost there. But during the 2020 year, when the exam was written, it used to be 80,000, but it could be 100,000. Yeah, it could be 800,000 because I tried to visit the similar website. Let me just try to recheck again. Let me just say deemed cost. Am I online? Oh my God, let me try to hotspot myself here. Deemed cost for passenger motor vehicles. Passenger motor vehicle capital allowances. Simra. right now online. Sometimes it takes time. This machine is lazy. Mm. Oh my God. So here they are saying this is not similar actually, but some uh, some people who wrote it that the deemed cost for passenger motor vehicles for capital allowances in Zimbabwe is determined on the cost to the employer as per the Finance Act. Okay, so that's what they're saying there. Capital allowances for from Zimbra, they are also saying that they're not saying anything about passenger motor vehicles. They're talking about other things, and but the common figure appearing there 100,000, donations. Then they're not having anything in relation to PMVs, passenger motor vehicles. So um, and you see the payroll, Payline payroll company is talking about the 2023 tax year. So um, so this is why I'm saying, guys, I'm giving a disclaimer. Okay, you may buy what I'm saying or ignore it outright at this point because of lack of information online. Um, but let me try to just bulldoze. Okay, let us try to use 80,000 as the safest. Because there are many sources that talk of 8,000. Even the examiner in this particular year used 80,000. But like I'm saying, you can use 80,000 as the deemed cost of the motor vehicle. All right. If you don't get it, use the 100,000. If you don't get it, then use the employer's cost, the actual cost incurred by the employer. All right, as that source said, which in that case you would use the 95,000. All right. So as for me, I should go with what the examiner used, and they used 80,000 in those years. The tax tables do not give us information about the deemed cost. Excuse me. Tax tables, where are you? Here, they don't talk of deemed cost for capital allowance. Um, the deemed cost here, this is for the loans. Deemed costs for motor vehicle, these are deemed uh, for the purposes of, you um, income tax. All right. if the benefit was, if the motor vehicle was given to employees, then when we compute the taxable income, or when we compute the VAT output, we'll then have to use this particular table, but not for the purposes of capital allowances. For capital allowances, oh man, for capital allowances, we don't use this part. It's assumed knowledge. You just know it. You need to be aware of it from reading extra, from going an extra mile to the Zumra website. So you need to play around the Zumra website and understand what the deemed cost could be or should be. So I gave you three options in an examination. Either you use the 80,000 for motor vehicles. Where is that? I'm saying either we use 80,000 or the cost to the employer. So it seems like it could be safer for now to use the employer's cost. Why? Because in the absence of the deemed cost aspect, it is quite safer, isn't it? It is quite safer to use the employer's what? The cost to the employer, which was the 95,000. However, for the benefit of teaching this particular aspect, what we need to get from this is how to compute the relevant figures and what to come out with by the end of the day. So let us use the cost to the employer. All right, the cost to the employer is 95,000. Sorry, 95,000 here. The handwriting is too big. So we say 95,000. That's the cost to the employer. And in that case, the deemed cost becomes the actual cost. So the table should be, the column should be deemed or actual cost. All right. And we use the 25%. All right. But like I said, the examiner used 80,000 because by then it was explicit. The website or the Zimra themselves in their notices had actually stated that the deemed cost for passenger motor vehicles should be 80,000. So any amount above that is not going to be entertained for capital allowances purposes, right? So if we use 95,000, then we are not going to expect to see the answers there. So it is better. This is why I said for the purpose of learning, let us use 80,000. So if we use 80,000, then if we apply the 25% cost, the special initial allowance at 25%, then it becomes 20,000. Remember, this was a zero for the farm. Why did you put zero? Because the farm is represented by land, and land does not attract any capital allowances. Are we together? Great. So 8,000, the 25% of that is 20,000. Tractors, commercial motor vehicle, the commercial vehicle, we apply the cost there of the cost by the employer, 135,000, and 25% of 125. 25% of 135,000, that's 135 multiplied by 25%. That's 33,750. That 3,750. Tractor, we use, let's just use the cost there, and the 25% for the tractor is 25,000, isn't it? Fiscal devices. The fiscal devices, we are required to only claim up to 50% of the cost. So 50% of physical devices, that's 25,000, isn't it? 25,000 of the physical devices. All right, and we take 25% of 25,000, 25,000 multiplied by 25% of that, that's 6,250. Irrigation equipment, we take the full amount there, 170 multiplied by 25%, that's 42,500. So the total amount we should get there, 20,000 plus 33,750 plus 25,000 plus 6250 plus 42,500. That's 127,500. And this should lead us to that. But I have given a disclaimer already that on the passenger motor vehicle, we must use a deemed cost. But because of lack of information and update, that could be, please refer further on additional information, and I will update you as soon as I get the relevant update. Okay, it is safe to simply use the figures for now because the aspect of deemed cost is not clearly provided for on passenger motor vehicles. It seems the Act has abolished that, and they are only concentrating on deemed cost of newly constructed assets as given on the website there. They were not talking much about motor vehicles or other assets. Look, this is the Zimura website we are talking about, and it is not clear as to what it wants on capital allowance.